Hi, my name is Mary Ann Sullivan, and I am a financial planner with South Bay Financial Partners, and I will be your presenter for session two, Design a Portfolio that Serves You. So, of course, we want to start this session with a warning. Investing involves risk. Everything we talk about is for informational purposes and education only. Any examples given are fictional and for illustration only and do not reflect what will or will not happen to you. We don't know your specific situation and aren't giving you specific advice. So you already had session one with Tara, which established your foundation and answered these questions. Are you ready to invest and how much can you invest? Now you are in session two with me and we're going to talk about portfolio design. How do you choose just the right mix of investments that will meet your needs and help you achieve your goals? And then next, you'll do investment selection. Which exact investments do you choose to put into that portfolio? And then the last session will be about letting your portfolio grow. What are the habits and actions that lead to long-term success? In this session, we have four parts. So this is session two, portfolio design. The first one is about risk. Just like our caveat said, investing is risky. So we want you to understand risk and evaluate your own risk tolerance and risk capacity. Next, we're going to look at portfolio allocation. What is the right mix of stocks and bonds to achieve your goals in your portfolio? After that, we'll take a moment to stop and look at your current portfolio. Chances are you probably have some investments already. So does your current portfolio fit you? And finally, we're going to make a plan. We're going to decide how we're going to take your current portfolio or build a portfolio that is in alignment with the allocations that best meet your needs. So let's talk about risk. In order to be able to mitigate and manage risk, you have to know your own risk tolerance and your capacity for risk. So these are two different types of risk reflection for yourself. Risk tolerance is how much risk can I handle? What level of risk can I have and still sleep at night? And risk capacity is when I look objectively at my life, how much risk could I take on? So these are two measures that we're going to go into detail. And here's the saying again, investing is risky. You see and hear this morning on every podcast, on blog posts, on social media. But what does this mean, right? So often when we see this term investing is risky, it's talking about the investments themselves. And yes, investing is risky, especially if you take action during certain times, right? So if your investments look on paper like they are down and you decide to sell, then you have realized those losses. So the ride is very bumpy. So I like to think of riskiness as bumpiness. How much bumpiness are you willing to handle in your journey in investing? So this first part is risk tolerance. So investing is a bumpy ride, and your risk tolerance is how much can you sleep at night and still see those ups and downs in your portfolio. This is the emotional side of risk. And we want to make sure you sleep every night. Sleep is important. And we have lots of tools that we have to measure risk tolerance. As financial planners, we have to make sure that we meet you where you are so that we create a portfolio that matches your needs. So we're going to share one of the tools that we use with our clients. It's called the Investor Profile Survey. You will get a link to take this assessment. And afterwards, a report will be generated. Now, if you were a client of ours, we would go through this report with you and help you understand it. So you have that option, of course, to always seek out additional time with us. And you can take some time to read your own investor profile. It's not a perfect science. Do you think it fits you? And the really important part of this is it gives you a recommended portfolio allocation. So as you look at this report, it's going to say something like you should invest 65% in stocks, 35% in bonds, and 5% in cash. So you have to reflect to yourself, do I feel like this is really matching who I am? Is it riskier or safer than what I think I'll be able to tolerate? So coupled with that is risk capacity. So risk capacity means Looking objectively at your life and your goals, how much risk could you tolerate in your portfolio? So, some people have less risk capacity. And the reason for that is maybe their goals are short term. I want to buy a house in 2 years, and I've already saved most of my down payment. We don't want to put that down payment in a risky investment, then we might lose it just when we find the perfect house that we want to buy. So if you have a short-term goal, and even those shorter intermediate term goals, um, that there's a big intermediate, right? There's a big difference between buying a house in 2 years and retiring in 30 years. In between that are all your intermediate goals. So looking at your intermediate goals and seeing how many of them are really fixed in time, how many are flexible, then you have to look at the risk capacity for those goals. If you're older, maybe you have less risk capacity. If you have retired with exactly as much in savings and pension and social security as you'll need to have a successful retirement, then you might have less risk capacity than someone who retires with excess net worth and can well fund a long retirement. If you have highly variable income streams, so if you're a freelance employee, then you might have less risk capacity. If you support many people, if you have a lot of family depending on you, you have less risk, right? And then if you're nearing a big transition, you also have less risk. You'll have more risk capacity if you have some of these characteristics. So if your goals are more long term, or your intermediate goals are more flexible or closer to long term. If you're younger and you have time on your side, you can invest in more risky things, give them time to bump around on that ride. Um, if you are in the middle of a career you love, or at the beginning of a career that you know you're going to do for a long time, you can invest in more risky investments as well. If you're a high earner, have high net worth, then you can invest in more risky investments. If you have more flexibility, so maybe you rent, so you could always like move to a cheaper apartment or move in with friends, then you could have more risk capacity. If you support less people, maybe you don't have children in your life yet, or maybe you have more disposable income, you have higher net worth overall, you can take on more risk. So that's the personal side of risk. Let's talk about now when we talk about risk in terms of financial products, right? So financial products also have risk in them. So the most common risk we talk about is investment risk, and these are the gains or losses. So there's kind of that classic journey that a stock might take, going up and down over the course of the business life cycle. And depending on when you buy and when you sell, you might get a gain or a loss. So this is the risk of investing, is that when you buy it and when you sell it, it might be a gain or it might be a loss. And over time, while you're holding it, it's going to look like it's going up and down. But really, the points that matter the most are how much did you pay when you bought it and how much did you sell it for? And then there's interest rate risk. So, what if better rates become available? And this can happen in good or bad ways, right? So, think of mortgage rates. We had decades of low mortgage rates, and now they are going up and up and up and up. So, buying a house now, there's a higher interest rate. You can't get as low of a mortgage anymore. Uh, on the flip side of that, bonds rates are going up. So, but me personally, being someone who invested very little in bonds for most of my life, now I find myself finding bonds that I really love. I love these safe investments and they have great rates. But what I also know is that as soon as they mature, who knows if I'll be able to get that same rate again. That bond and that rate will be gone. And in 5 years and 10 years, who knows what the rate might be? It might be higher, it might be lower for that bond. And so what I was just talking about leads into the next one, the reinvestment risk. So that's that lack of opportunity to reinvest at the same rate at maturity. And then finally, this last one is something we're all really familiar with right now. It's our purchasing power risk, aka inflation. So what if inflation outpaces returns, right? If I take my cash and I put it under my mattress to save for my retirement, well, by the time I get to my retirement in 20 years, that cash is no longer able to buy as much as I thought it was going to when I first put it under my mattress. So for our own long-term goals, we have to invest and in a way that will outpace inflation. Okay, so that closes our section on risk. So we have a couple of reflective questions for you. So remember to take that investor profile survey and really read the report. What stood out to you about the results? Does it accurately portray you? Um, does it align to your identity as an investor? And then thinking about what you've learned about risk capacity and risk tolerance. Do you think you could change some of those numbers on the recommended portfolio allocation? And then make a decision. How do you think you want to structure that portfolio? What percentage do you want to put into stocks, which are more risky, bonds, which are less risky, and cash, which is the least risky? So we're going to be going into allocation more in the next sections, but keep that recommended portfolio allocation handy with you. And I'll see you in the next section.